Good morning, and thanks so much for tuning in. This is Stocks to Watch on Bloomberg Quint, and I'm Alex Matthew. It's going to be a busy day of trade on the earnings front. Five nifty companies announcing results, but we're going to be speaking about only one of them today, and that too on account of a strategic partnership rather than earnings, mostly. We'll get to that in just a bit. My guest today is Rasmik Oza of Kotak Securities. Good morning, Rasmik, and
Hi,
thank you
good
so
morning,
much,
Alex.
as always, for joining me. I want to start with ICICI Prudential Life Insurance. The earnings came in yesterday, and let's pull up some of those key numbers on the screen. Gross premium up just over 6.5%, net profit up about 0.4%. But I thought the persistency ratio, 13-month persistency ratio, looked quite good at 83.7%, at least compared with the previous figure of 80.7%. You also had the VNB margins for the half year improve to 26.3% compared with 21%. How would you look at the numbers, and would you be positive on this space? I know a lot of people have said that they're positive on life insurance in the long term.
Yeah, Alex, I think ICICI Prudential Life numbers are in line with what we've seen in the other peers also. The internals of the numbers have been quite encouraging. So, similar to what HDFC Life is, gradually ICICI Pru is also going towards the same path. What we have seen is the VNB margins have improved a lot, as I mentioned, from 21% YOY to 27%. We expect this to be at par with HDFC Life going forward at around 24-25% as a steady rate going forward. What the company has done is, they have done severe cost cutting in the last quarter. They've reduced the non-saving linked schemes, in the sense where they have to actually get more margins. So higher non-par plus higher non-saving linked products have led to better margins because they don't need to share the profits of the company or the dividends or bonuses over there. So this has helped improving the margins, even though the APE, we call it the average premium equivalent, has gone down by 26%. Mainly it's on account of the sharp fall in the ULIPs. ULIPs have gone down 45% in the last quarter. But going forward, I think so, as per the management indication, we will see pickup in ULIPs in the second half of this fiscal year. If you're looking at a 2-year perspective, maybe this year, next year, earnings should grow at around 14-15%. And in terms of other metrics, I think so maybe the return on embedded value gradually should go up from 12% to 14-15% next 2 years. We value the company based on price to EV, that is embedded value. And our benchmark for valuing ICICI Prudential is at around 2.1 times. At that price, we get a price target of 500 rupees. So there is a decent upside from the current market price to 500 rupees in the stock.
Understood. Okay, so clearly there is some room to buy this stock. Let's talk about the second stock, Castrol India. And the earnings for the September ended quarter also were announced. And you see that on the screen, right? You have a significant improvement in EBITDA margins at 32.6% compared with 28.8%. And I would think that's on account of raw material prices, particularly crude, having fallen significantly in that period. PAT is up nearly about 8.6% for the period. What is your view on this counter, though? MNC name, but has it really performed in line with what you expect, and do you expect it to do so going forward?
Yeah, so Alex, the company used to be one of the favorites of the market earlier, but then gradually when BP took it over from Shell, then they reduced the exposure or their weight from 74% to 51%. That was the first phase of derating which you saw in the stock, and since then the business environment actually had turned a little negative. Last year, automobiles did not do well, and then we had this pandemic. So on a sequential basis, the Q2 results have been far better than Q1. On a YY basis also, you've seen a flattish revenue, a slight marginal improvement. But as you rightly said, companies like Castrol, their raw material is base oil, which is basically, they get a positive impact of fall in crude prices with a lag effect, maybe 1 or 2 quarters after the fall. So post the correction, now they're getting the benefit of raw materials to their benefit. I think going forward, as the economy is now come back to almost normalcy, and demand for diesel petrol is almost gone to pre-COVID levels or closer to pre-COVID levels. We expect the demand for lubricants also to pick up, and Castrol, being the leading player in the branded lubricant space, will stand to benefit. Key things to watch it: A, the company should again go back to normalcy in terms of operating metrics next year. So we expect the company to report almost more than 60% ROE next year. Stock trades at around maybe 12, 13 times on 1 year forward, because it's a calendar year now. One needs to discount calendar year 21, and on
Mm.
that it is trading at around 12, 13 times. Dividend yield will almost at current price walk to 9 to 10%. In this first 3 quarters, they paid around 8 rupees dividend. If we
Mm.
anticipate another 2.5 rupees dividend in the last quarter, that's December quarter, you get an annualized dividend of more than 10 rupees. So the dividend yield goes to close to 9 to 10%. So we're extremely positive. Our earlier target was 165. We haven't released our Q3 update in the morning today. So more or less, I think so. Price target should remain there only. So we've got a very extremely rich upside from current market price. We're extremely bullish on this company.
Fair enough. And there is a significant upside in Castrol as well. So it is a strong buy from Rasmik's side. Let's talk about the third counter, Rasmik. And I know that it will be in focus today on account of the earnings, but perhaps the headline that came out last evening will be more interesting with regard to Hero MotoCorp, right? Which is the tie-up that it has announced with Harley Davidson to develop and sell a range of premium motorcycles in India. It will also take up Harley Davidson's existing sales and service operations in India. This comes about a month after Harley Davidson announced that it would be exiting the country. Interestingly, just a check on our end pointed out that Hero are developing a 300 to 400cc motorcycle, and perhaps this would help to that end, Rasmik. What do you think about this partnership, and do you think it will really help it develop in a space that it has been lagging, if you can call it that, for Hero MotoCorp, considering that it's a leader in the entry level segment? And what do you think about the earnings?
So, Alex, there are two things. One is the manufacturing or the developing side, and the other is the marketing side. If you look at Maruti, they have two formats. One is a normal dealership, and then next is Nexa for the premium side. So I think Hero MotoCorp may not be able to. I think they'll be clubbing with the distribution, of both these companies. Harley Davidson, if you look at the past, they started selling some 2, 3 years back 11,000 bikes, and then last year FY20 their volumes had gone to below 5,000. Now, if you compare this in the context of what Hero does the annual sales of almost 54, 55 lakh bikes with
Mm,
average realization of around 51,000. Now, even if you say, there is a 5 to 10,000 volume coming with a realization of to 3 lakh rupees also, I don't think so. It moves anything on the numbers for Hero MotoCorp. But yes, it actually fulfills some gaps which the company had in the premium segment. It's a niche segment. Maybe it's very futuristic. India is still not ready to move into that gap, especially considering the pandemic and the uncertainty, job losses, and other aspects which is there in the economy today. But yes, maybe on the 3 year, 5 year down the line, if Hero uses its skill set in this business in terms of distribution and creating awareness, I
mm,
think it could ramp up. But as of now, I don't think so. That is the thing. Just to add, Alex, today Hero MotoCorp results are also there.
yeah,
Q2 results, we're expecting around 20% revenue growth over there. It's a
right,
combination of 7% volume growth and 12% realization. There are price hikes were taken in the first quarter, which is reflecting. Uh,
right.
so overall, the stock we had a sell recommendation. We'll have to just revisit the thesis after the Q2 results. Our
Okay,
price target of 2,700 is based on around 14 times on the core business, and we attribute some 440 rupees to the cash and the other investments.
right.
That's how.
Okay, well, that's the view on the three stocks we chose today. Thank you so much, Rasmik, for joining in. And indeed, thank you so much to the viewers for having tuned in. Do stay tuned. Like I said, lots to talk about today. Thanks so much for tuning in.
Thank you.